Hey, what's going on, cash flow hackers? It's Chris with Life 180, and today we are talking about why whole life insurance is the best place to keep your emergency fund. I know that may come off as kind of awkward to most people, and they think, well, how could life insurance be an emergency fund? Well, I've done videos on this before. I'm gonna spend a couple minutes kind of setting the stage as to why whole life is the best emergency fund, but I'm also going to address the number one, I guess, rebuttal from people like Dave Ramsey and Suze Orman and the fans that kind of follow that philosophy of them buy term and invest the difference. And that number one rebuttal that they utilize is saying, well, whole life is inflexible. Why would you want to have your emergency fund inside of a product that requires a payment? And so I'm going to answer that question here shortly. But before, if this is your first time here, I'm going to set the stage with this. But if you find value in any content like this, if you're going down this journey, I really encourage you, join the channel, like, subscribe, hit the bell. That way you're notified every time I launch a new video. I got videos like this coming out all the time, so let's go. And I'm going to just get into this. So first and foremost, one of the things that I say is that life insurance is an amazing emergency fund. When we look at the emergency fund element of life insurance, the biggest thing that we have to talk about here is, well, what defines an emergency? Dave Ramsey will say you need 6 months of lifestyle style/income, right? You got to have your 6 months of income in a safe place in case you have an emergency. And in his mind, I think an emergency is stuff like you lose your job, maybe car issues, home repairs, stuff of that nature. Now, I'm not saying that these things are not inconveniences, but my belief, my philosophy is if you're looking at those things as financial emergencies, well, then I don't think you're seeing the playing field properly. I don't think you're looking from a high enough level at what the real emergencies and what the real risks in your life might be. To me, an emergency is something like, I don't know, cancer, heart attack, stroke, stuff of this nature, right? This and other what I would call critical illnesses, right? These are the real emergencies. And when we look at this and we say, all right, 6 months of income, if you get diagnosed with this, if you don't have your financial structure properly set up and you don't have the right insurances in place and all this stuff, well, then you're in a lot of trouble, right? I know too many people that are in their 40s and 50s, low 50s, that have had issues that have been diagnosed. I share the story sometimes. My best friend, JD, actually passed away at the age of 51. He actually got a tooth infection, and the tooth infection spread. The infection spread down to his heart. Apparently, this is a common thing. And then they ended up having to do emergency surgery on his aortic valve, and then it was supposed to be pretty common surgery, but they got in there. It was worse than they thought it would be. They opened him up. They did the operation. He ended up in a coma for a month. He ended up living through that and then had to do 6 months of rehab. But then at the end of the rehab, literally the day before he was going to be sent home, he died of a brain bleed because of the blood thinners that they had him on. And so after all that time, after I was going to the rehab center 3 days a week to help him learn how to walk again and do all these things, and after all that time, he passed away. And a lot of this has to do with the fact that when we were best friends, it was during the time that I didn't have my licenses. I couldn't do much to help him. Between 2016 and 2022, I didn't have any licenses, so I couldn't sell him anything. And so I have to live with it every day that even though I didn't have my licenses, I still knew all the things, and I knew he was underinsured and all this stuff. I just didn't want to push. And, this is one of the reasons that I believe so deeply in what we do now, and why I think it's so important that we share this message. And to me, emergencies are this, right? And that's why I believe that your emergency fund should take those into consideration. So if you have your money in a savings account, well, 6 months doesn't do much. But if you keep that money in a whole life policy, you get what's called accelerated benefit riders, ABRs, okay? And if you become critically chronically or terminally ill, you can access a portion of the death benefit while you're alive to help you cover any of these issues, right? Like, so this is a really, really powerful component to saving money in a whole life insurance policy. Is there a cost? Sure there is. I mean, there's always going to be a cost, okay? So like if I look at a savings account and I look at a whole life policy and I say, all right, if I look at how much money I'm putting into these policies and I say, all right, I'm going to save, let's say I'm saving $10,000 per year. Okay. In year one, well, I'm going to have in a savings account, $10,000 plus whatever interest rate that I have. So let's just call it $10,000. In a whole life policy, if you design it the right way, you're probably going to have $7,000 available. Now, Dave Ramsey doesn't like to have this conversation because the way he likes to bang on whole life insurance is saying that you don't have access to any cash value for probably 5 or 6 years, which there are ways to design whole life insurance policies where that is the case, but that is not the way you design the types of emergency fund policies that I'm talking about. You know, by year 2, you've put in 20,000 total, so you have 20,000 plus change. You know, in the whole life policy over here, instead of you're putting in 10,000 the next year, but you're probably going to have like 15,500 of cash value. So yeah, it's not as good. You're not going to have as much of cash value there. But if we're utilizing it for emergency funds, well, now we have to say, if this happens here and we have an emergency fund with $20,000 and then something bad happens over here and we become critically, chronically, or terminally ill, the fact that you don't have the riders there, if you have this 15,000 and this happens, well, now all of a sudden this 15,000 is amplified, and instead of having 15,000, you might have 200,000 to help you cover for medical expenses and stuff of that nature, right? That is one of the powerful elements of utilizing whole life insurance. Now, I wanted to like really just kind of set the stage with that for a second because I think it's really important. I don't think most people understand the power of that. If you want to learn more about this, I encourage you, go down below, click on the link, set up a clarity call with a Life 180 coach. We can help you go through that and really we call it a clarity call because it is designed, I promise you, it's designed to not be a sales call. It's designed to help you have an understanding and have real clarity. Now, let me get to the rebuttal. The biggest rebuttal. Whole life is not flexible. Okay, so they say whole life insurance is not flexible. Okay, if you have an emergency, they say in a $20,000 or in a $10,000 a year plan, when we're going through this plan right here, and in a savings account, if you lose your job, you have an emergency, well, guess what? You don't have to pay that $10,000, right? That's what they say. And okay, if that's the case, well, guess what? If you have any of these issues come up, yeah, you don't have to pay this, but guess what? Or you don't have to save, but you don't have much to help you solve your problems either. I got news for you. If any of these happen, with this happening over here, you get to accelerate the benefit. You don't have to make that payment either anymore, because as soon as you turn this rider on, you're activating the rider and the death benefit, and you no longer have to make a payment on that. Think about the power that brings to the table, okay? It is wildly powerful when it comes to your financial planning, the different ways that you can utilize this. Now, I'm a big believer in planning to make sure that our financial plan and strategy is going to be successful no matter what happens to us, but we got to have contingencies. We got to have plans. If things go really well, then we got to make sure that we know what our assets are going to do for us, but we also have to prepare in case things don't go well. And if things go poorly, well, then we need to make sure, like if things go poorly like this, we need to make sure that we're protected. If 10 years down the road we lose money and we need access to capital, we need to make sure that we have access to capital to be able to weather the storm through the case of, like, if you lose your job or whatever, you have income or you have access to cash that can help you weather that storm and make that transition. That is where people say whole life is not flexible. Well, I got news for you. Whole life is flexible. It's wildly flexible. I encourage you to go look out some of my other videos. I'm not going to go into the level of detail of going through illustrations that I went through before, that I've gone through on this on other videos. But what I will say is this, is that what happens is you have a premium amount. You have cash value, which is how much cash value you have access to, the net cash value that you can borrow against and leverage or withdraw and access your money. And then you have a death benefit. Okay, so if you had somebody that had a $10,000 premium, let's just take a 35-year-old that's healthy, you're looking at a death benefit probably of about $400,000 in that range on $10,000 a year. Now, Dave Ramsey would say, well, you could go get $4 million of death benefit or more, and probably way more. You could probably get $5 million of death benefit for $10,000 a year at 35 years old, if that's really what you wanted. Maybe even more than that, but that's not the point. The point is we're designing this for solving multiple purposes, solving multiple problems in our life. And in this situation, if we did it right, we'd have about $7,000 to $7,500 cash value available year one, okay? And now out of this, what does that mean? Okay, that means what we've done to pull this off is that we've used a base premium and then what's called a paid up additions premium, okay? And so out of this, what's going to happen is the base is 30% in the example that I just used, and the paid up additions is 70%. So one of the things that people need to understand is that this paid up additions is completely flexible if you choose the right company. Not every company is this way, but if you choose the right company, that's why we work with 5 different companies to be able to partner people with the right companies that fit what their needs are. 70% of this premium of the $10,000 is not required to be paid, meaning you could drop your premium down to $3,000. So if you had an emergency, your premium is $3,000. Furthermore, if you had an emergency, the premium, I think, it's always good to have a process where you have a forced savings plan. I think having a bill come in the mail, so to speak, for an insurance premium is just good financial behavior. It's like a forced savings plan because most people don't save as much as they say they're going to save because life happens. But when you have a bill in the mail, it actually happens, okay? Now, the $3,000 that is required to be paid, there are ways that we can manage that premium, right? So we can use what's called a premium offset. And by doing a premium offset, that's basically utilizing the cash value in the policy to make the premium so you don't have to come out of pocket, right? Or I should have done that, not that right there, okay? It would have been coming from the cash value. So you don't have to come out of pocket even if things get rough, okay? And so now when you get back on your feet, you keep paying $10,000, you keep growing. You keep paying the $10,000 every year, and this cash value goes up. And the thing is, cash value in a whole life insurance policy, MassMutual just launched a study that showed the real internal rate of return, net of all fees, of MassMutual whole life policies for 30 years up to 2018. That's the most updated study that I can find, is 6.13%. That is the internal rate of return, net of all fees. Now, that's not super attractive. That's not going to compete with investments. That's why I say it's not going to beat investments. But from a long-term perspective, we have to look at what the returns of our safe money are going to be. We need to beat what we are trying to do in a bank effectively. And ultimately, whole life insurance is going to give you bond-like returns, which is actually going to be better than bonds if we look at this from a long-term perspective. So it's going to give you bond-like returns, money market-like liquidity, and municipal bond-like tax treatment, because this is all going to grow tax-free, whereas bonds don't necessarily have that tax treatment. So one of the things that I want to say here is everybody says whole life is not flexible. It's way more flexible than you think. There are different strategies depending on how you design the policy. If you design a fully based policy, like are the policies that Dave Ramsey likes to rant against and rip on, if you have a fully based policy at $10,000, well, then that's going to be a little more challenging. But if you design the policy properly, you build in a lot more flexibility. If you utilize the right companies, you have a lot more flexibility to not just use the the cash value to actually make your premiums for you through the premium offset feature. But now you'll have a makeup period where you can now go back and make up for the lost paid up additions that you weren't able to put in when times were tough. And when you get your new job, you get back on your feet, you get more cash flow. You obviously want to keep saving to make up for lost time. That's just the way it is. So at the end of the day, I will stand on this mountain and die for the fact that I think whole life insurance is the absolute best place to save your emergency fund. My opinion, and I'm willing to debate anybody about this, is that whole life insurance beats a savings account, beats bonds, beats any other account right now. The people that say high yield savings accounts are better because high yield savings accounts have rates that are elevated right now. Where were you 3-4 years ago when whole life insurance was dwarfing the returns that you get inside of a high yield savings account when they're yielding a tenth of a percent, 10 basis points? It's just laughable to me that all of a sudden for a couple year period of time, things spike up. Well, as interest rates go back down, whole life insurance is going to always stand the test of time. That's just what it does. You're not planning for the next couple of years. You're planning for a long period of time. So you got to use tools and financial strategies that are in alignment with what your actual time frames and goals are. And so that's what I want to impress on you. If anybody has any, argument or variance to this, I encourage you to comment in the comment section below. You want to challenge me, let's get on an interview and let's have a conversation. So anyway, I hope that helps. If you haven't already, make sure you subscribe and hit the bell that way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.